So almost every economy today is getting hammered by higher interest rates. And when it comes to Australia, it is hitting the country really hard. Now, back in June, the world's biggest bond manager, PIMCO, bought up tons of Aussie bonds saying that a recession is inevitable for the country. They are loading up because higher interest rates are inflicting enormous pain on the economy. And if we listen to the people on the ground, the situation isn't good either. 70% of businesses surveyed predict Australia will fall into a recession within 12 months. Australia is in a very bad position. Of all the developed economies, Australia has one of the highest combinations of inflation and interest rates. It is a double whammy that's starting to collapse businesses and consumer spending. Plus, Australia has a really insane property crisis going on that is literally bleeding renters and borrowers dry. And as interest rates continue to go up, borrowers are going to feel the impact. In our lead story today, Australia's central bank admits that the share of borrowers in early financial stress has increased. If you're a central bank, that is the last thing you want to say. It reveals that the rate hikes are starting to crush consumer budgets, and according to the bank, up to 13% of borrowers are spending more on essentials and mortgage repayments than what they earn. So people are not just treading water, they're actually underwater. And when borrowers are spending more than what they earn, there's only one conclusion: they are swiping their credit cards. The double squeeze of inflation and higher rates is literally destroying the consumer. Now, you would think that the pain of higher rates is going to stop. The central bank can't possibly hike again, right? But you might be wrong. There are many factors in play today that are forcing rates in Australia to go even higher than 4.1% today. According to a recent poll, the majority of respondents, including Australian banks, see rates going higher. Almost two-thirds believes that rates will reach 4.35% or higher by year's end. And as you'll quickly see, this might become a reality very, very soon. And you know, things are very bad when economies are relying on Taylor Swift to help prevent a recession. Sure, there will be a lot of spending happening, but the fundamentals in the country are inherently weak. And this is where we need to talk about Australia's inflation crisis, because not only is inflation high, it is actually going in the wrong direction. Looking at Australia's quarterly trimmed inflation rate, we see it's dropping gradually over the last 3 quarters, from a peak of 6.9% down to only 5.9%. And this is the inflation that most Australian households are feeling, and that is burning up their buying power. All your money gets channeled towards food and rent. We have literally nothing left over. And if we look at the monthly CPI, the inflation data actually looks worse. The August print has increased to 5.2% from the previous month of July. Australia is experiencing a rebound in inflation, and this is going to tilt the balance towards further rate hikes. According to ING Bank, inflation surged back across all categories, almost all of them. The biggest change came from transport, increasing nearly 4% thanks to higher energy prices. However, food and beverage also saw a price increase of nearly 1%, adding further pressure to household budgets. And let's remember that OPEC Plus sent oil prices soaring in September, so the inflation reading next month is going to be equally bad, if not worse. And this is going to ring the arm of the RBA to bring on more inflation rate hike pain. So far, Australia's central bank has kept interest rates steady at around 4.1% for the fourth month running. And this is well below the CPI inflation rate of 5.2%. Even the Federal Reserve in America has hiked rates well above inflation because that's the only cure central banks have for it. The playbook has always been to hike rates well above CPI to destroy demand enough. So if CPI is at 5.2%, interest rates should be well above 5.2% as well to drive it down. But Australia isn't doing that, and this begs the question, why? Maybe it's not because of inflation. That might not be the big problem, but Australia's real estate crisis is destroying the budgets of borrowers and renters in the country. And this is the double whammy that we are talking about that's happening all over the world. Consumers are getting hit by inflation and rising housing costs. But in Australia, this is amped up to 11. And if you're looking for a home in Australia, whether it is to rent or to buy, you're going to get a black eye. There's an affordability crisis because real estate shortage in the country is getting worse by the day. In a report by ABC, there are now 1.5 million Australians at risk of mortgage stress, and this means they might not be able to meet those monthly payments and they are falling behind. And if we narrow this segment down further, we can see nearly 1 million borrowers at extreme risk of defaulting on their mortgages, and this number has been steadily increasing as interest rates continue to go up. It is a direct correlation. The problem is that Australian mortgages aren't like those in the United States. Fixed rate mortgages might be popular in America, but it is a totally different story in Australia. The vast majority of mortgages are tied to variable interest rates, and this is a nightmare in today's environment. According to the RBA, 70% of Australian housing loans are variable rate mortgages. Compare that to countries like the US or even the UK. We can see why their central bank doesn't dare to hike any further, even though inflation is still high. And it's not just variable rates that are problematic. Fixed rate mortgages in Australia have extremely short tenures. It isn't America where 10, 20, or even 30-year mortgages are the norm. In Australia, the most common term for fixed rate is 1 or 2 or maybe 3 years. And this means there's nowhere to run if the RBA decides to hike rates further. Either your variable rate mortgages readjust up, or you'll have a refinancing shock when it comes to roll over your fixed housing loan. The RBA themselves confirms this in their half-yearly review. Most borrowers with variable rate mortgages will see their payments rise up to 50%. And if you're on a fixed rate loan, your increase will be similar when it's time to refinance. But the rental market in Australia is just as bad. Of all the developed economies in the world, Australia's rental availability might be the worst. Housing's vicious spiral drags Australia into deepening crisis. The supply of rental homes is shrinking fast, and this is making it near impossible to find affordable housing. And here's how bad things truly are. The rental vacancy rates is just 0.9% in Australia, which is ridiculously low. And this means for every 1,000 units, only 9 are available for rent. In a building of 100 units, there might not even be a single unit available to rent. And this causes rentals to soar to ungodly levels. And that's why Australia is in a limbo financial crisis. On one hand, they can't fully fight inflation because it might collapse real estate borrowers. But on the other hand, if they don't, inflation could stay sticky for years to come. But it's not all doom and gloom for Australia because Australia is a major exporting country and they are very rich in natural resources. They can tide over this crisis if they play their cards right. But let's go through the bad things first. Let's go through the bad news. Like in many other countries, Australian exports have been dropping as the world slips into a global recession. The ABS reports that exports of goods fell by 7%, the largest fall since the June quarter of 2014. And as commodity prices like coal and LNG continue to fall from the 2022 highs, this is going to squeeze Australia's revenues even more. Australia is facing double headwinds of lower demand globally and commodity prices slowly coming down. Australia's biggest imports includes coal and iron ore. However, that is coming under tremendous pressure as well. Forecasts are showing that Australian export earnings are gonna drop, especially in commodities. Over the next 2 years, iron ore exports will fall by 20%, LNG will fall by 30%, and coal export earnings will crash by 46%. And this isn't good for Australia's balance of trade, and that could send them tumbling from a surplus down towards a trade deficit. And with all the economic problems they have, the last thing they need is a higher deficit spending. But thankfully, there's a silver lining to this story. Relations between Australia and China are beginning to improve. And this is critical because Beijing is their biggest trading partner by far, representing over 30% of Australia's total exports. In a report, China to drop tariffs on Australian barley amid diplomatic talk. And this is good news because now Australia can export more commodities to China to earn additional revenue. China's economy is still growing fast. They still have a powerful consumer base that needs commodities. So even if there's a global slowdown, maintaining trade connections with Beijing is crucial for Australia's survival. But there's a big problem looming on the horizon that could literally derail everything, and this is the AUKUS deal. Now, if you're unfamiliar with this, it's basically the United States, the UK, and Australia agreeing on a nuclear submarine deal. It's basically a plan to create a fleet of nuclear powered subs to counter China. Now, Australia will be buying the nuclear subs from the United States, and I think you can immediately tell that China won't be thrilled with this development. China could always slap additional tariffs on Australia, which won't be a good thing. But if we look at the AUKUS deal itself, this is going to cause a bomb as well. In a report by Reuters, Australia's nuclear sub deal could cost up to 245 billion US dollars by 2055, and this is an enormous expense for Australia that might just antagonize its biggest trading partner. And the only winner I see from this deal is the United States. They'll be making a ton of money. So we have to watch this development carefully. The economic consequences could be very big. But let's head back to the main event, which is the rate hikes. Will Australia hike their interest rates further? Because if they do, it could destroy mortgage holders and send rents soaring through the roof. But there might be little choice because America is likely going to hike further. And when the Federal Reserve hikes, it places tremendous pressure on other central banks to follow suit. In an ominous report, the Fed is leaning towards another rate hike after a blowout payrolls report. The US economy added 336,000 new jobs in September, surpassing all expectations. And this isn't good news because it signals that the Fed will likely ramp up rates higher to crush demand. They need to destroy demand to bring down inflation. That's the only trick they have. And the effects of this will trickle down to Australia. When the United States jacks rates up, it causes the US dollar to strengthen against other currencies, and the same rule applies to the Australian dollar. Looking at the Aussie dollar versus the reserve currency, we can see it has been falling ever since the Federal Reserve started hiking rates back in March 2022. It has fallen by at least 10% to the US dollar, and this makes imports more expensive for Australia, increasing local inflation. And this squeezes consumer spending and is an invisible tax on Australians. While Australia does export more to the world, they also import a ton of stuff. In 2022, their total exports stood at 668 billion Australian dollars, but their imports stood at 513 billion and are increasing fast. So it is not too far off from their exports number. If the Federal Reserve keeps jacking rates up, the RBA will be forced to make the impossible choice. Do we hike to protect our currency and fight inflation? Or is saving the mortgage market, saving the mortgage holders more important? Because either way, people will get squeezed further. So far, Australia has tightened policy at the slowest rate compared to other central banks. New Zealand, America, and Canada are all well above the 5% range, but Australia is still at 4.1%. And this is the problem with inflation. The moment it gets out of control, it exposes the weakness in every single country when rates go up. In America, the weakest link is Wall Street and their over leverage, but in Australia, it is their real estate crisis. So watch the Fed funds rate because if it goes high enough, it could pressure the RBA to throw in the towel and hike their own as well. But let me know what you think in the comments below. How is Australia's economy doing? Will they do the unthinkable and hike again? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.